let's go to the next piece on how do we create sustainable alpha. I think Mudit just took you through one example of how we create alpha in operations. Let me just take you through another thought process of how one can create alpha. And please note, we are not talking about seeking alpha. We are talking about the approach where we can actually be very confident that alpha generation will happen. So we are looking to create alpha as we go along. Yeah. Now, when I use the word financing, typically what I mean is using additional financing to enhance returns of low risk trades. So I've often had conversations with a lot of our investors, not one or two, a lot of our investors, who, when we start, always tell me, we never take leverage. We've never taken leverage in our life. We have so much capital to invest. आप उतना तो कर दीजिए, leverage की कोई ज़रूरत ही नहीं है. Now, and I, from the first day, and they must be thinking ये क्या है, but I start telling them, sir, I know you have enough capital, but let me tell you that there is a difference between leverage and financing. We would like you to set up a line, and we'll explain to you how this line can be used very efficiently as we go along. So, our view has always been that leverage can be habit forming, but you can use, or one can use, financing as a means for return enhancement. So let me again use the example of a company. So what I'm trying to do is give examples of real world companies and the investing side both. But real world companies, we see all the time an operating company taking short-term overdraft facility as opposed to a long-term debt. The whole idea is that you're not trying to, you're actually trying to play the cycle. So let's say there's very high demand, which is there during Diwali time for a company. Now we've seen this happen. So then, or there's a seasonal demand, let's say in soybean, for the soybean crusher right now today. Now those people would require capital, which will be utilized for a period of 2 months, 3 months, 4 months. They don't want to create permanent leverage lines on their balance sheet. So they are all using financing solutions, short-term financing solutions. Now, if in our operating businesses, we understand the concept of short-term financing solutions, clearly on the investment side also, there's an opportunity to understand the same solutions and to utilize them.
So let's talk about how we can do this in the special situation strategy. Now, special situations PMS is something which a lot of you would have heard about from us. These are basically corporate action-based, event-based trades, things like open offers, buybacks, delisting, merger out. And this is, in a year, you would see anywhere between 300 to 350 such events that take place. We look at each and every one of them, but actually not all of them translate into trades because the opportunities might not be there or it might not make sense. But at a point in time, you might see a few of them coming together. There might be times of the year when you would not have opportunities, and some of them can be very, very scalable. Now, this is where you can use financing quite well. The question again is, when do you use financing? Just like Naresh was talking about the fact that in an operating company, you don't use working capital lines if you're trying to put up a project. So for a project, you would want project financing. For your regular flow of business, you need working capital lines, you need LCs, BGs. So similarly, let's try and understand, where is it that you would use financing for special situations. Now let's take the case where the outcome is uncertain. Now, what does this mean? This is effectively when you are doing a risk trade. Let's take an example. We have seen a couple of large delisting trades or delisting events that have happened over the last many months. One of them was Hexaware, which went through successfully. Another one was Vedanta, which didn't go through successfully. So the reverse book building process actually failed and the delisting didn't go through. Now, post facto, you can say, there is the tendency to say that Hexaware was a safe trade and Vedanta was a risky trade. But that's not actually true. The fact is, when you are in the trade, when the event is actually happening and the book building process is happening, both of them are risk trades. the possibility of a risk of the trade failing is there in Vedanta. It's there in Hexaware as well. And this is where you need to understand that when there is a risk trade on, that is not what when you want to take financing. This is when the expected return can be a lot higher, but at the same time, given the risk, you don't want to use additional financing. Let's take another case. We can move on. Naresh? So when the outcome can be certain, so you're looking at low risk trades or medium risk trades, but the timeline is uncertain. And this is something where we have seen, let's say, for example, open offers where either the acceptance ratio is quite high or it's close to 100%. But a lot of these corporate events, effectively, they need to go through the regulatory process. They need to get the approvals from SEBI, other regulators. And also from time to time, what might happen is that there could be impediments that could come. Probably one of the best examples, which is quite unfortunate what happened, but if you look at the Fortis open offer. Now, Fortis, if you look at the event itself, it's gone through as you would expect, where IHH has taken control of Fortis, and they should have done an open offer for minority shareholders. And this is something which would have become a very interesting trade. But if you started taking leverage for a trade before there was certainty in terms of the timelines, the problem is in something like Fortis, unfortunately, there's been a litigation that is pending, because of which the whole process has been stalled. So this is again a case where you don't want to invest using additional financing. So where is it that you really want to use additional financing? When the outcome is quite certain, so you have a low to medium risk trade, and it's also a defined time frame. So you know that all the approvals have been are got, and you're coming towards the tendering period, or you are in the tendering period. That is when you really want to invest using additional financing, because that is when you might have built up a small position of 5 crores, 10 crores. But this is where if the opportunity is there, this is where if you have a defined time frame, you have a defined risk metric. That's why maybe you want to take a 5 crore, 10 crore trade into a 200 crore trade, or maybe more also, depending on your lines and your capacity at that point in time. Also, very interestingly, when in cases which are low risk trades, there is a defined time frame, but also there are market dislocations, and we'll probably go through some examples of that. So there are problems with the rest of the market. There's no problem with the event itself, but the general environment, there are market dislocations. That is when you really want to cash in. That is when you really want to pile on and probably take even more financing than you would otherwise. And this is when, if you have your lines available, if you have the capital available at that point in time, you can really clean it up. So net, what we would say is special situations is a good example of a strategy where you don't want to keep capital aside purely for the strategy, because there would be periods of time where it would be undeployed. But at the same time, if you didn't have capital available when the opportunity comes, you can lose out on some very, very sweet opportunities. So all of this is good in theory. Let me take you through an example which will probably hit home a little bit more, because a lot of you would have actually taken this trade. We have explained this trade, and a lot of our clients have actually taken advantage of this. So this is an open offer for a company called Indostar. Now, Indostar is an NBFC set up, promoted by Everstone Private Equity. And in the beginning of this year, they got Brookfield, which is a large Canadian institution, to come in as a co-promoter, as a strategic investor. So Brookfield was mandated to do an open offer for all minority shareholders at 290 rupees a share, which is where they did their primary and secondary as well. And effectively what happens is that because this was an event, this was an open offer, where the open offer size was as big as a minority shareholding that was there. For every share that you held and you tendered, you would get your 290 rupees, which is what we call a 100% acceptance ratio. Now, there are some events where you tender 100 shares, you might actually only 50 might get accepted and 50 might get turned back. That is when there is market risk, and that you assess very differently. Something like this doesn't really have market risk or price risk, but what it does have is time risk. So when the event gets announced, you know that because it is an NBFC, it needs RBI approval, needs SEBI approval. So you start taking the trade, because when the price comes to about 270, you know that this is something that is going to happen over a period of 4 to 5 months, and it is still a very attractive yield, because you know you will get 290 rupees at the end of it. Now, if 4 to 5 months becomes 6 to 8 months, that's still okay, because especially if you've not taken financing, because you don't have to bear the burden of the interest cost as such. But guess what? A safe trade like this, when you come to a March where the world is going crazy, and the Nifty is going to 7,500, and stocks are falling off by 40-50%, and probably people are having margin calls, probably people need to sell the stock for other reasons, the price actually comes down below 250. Now, in normal markets, this should not happen, because any arbitrager would come in at this point in time and say that I buy it at 250, I can get a clean 290 rupees at the end of 6 months, even if I don't take 3 to 4 months, even if I take 6 months, 7 months. That's a fantastic return. That's 20% absolute returns on a completely risk-free trade. Also, the analysis that you've got to do at this point in time is, is there a possibility of the company going, if of Brookfield not going through with the open offer? And this is where again you see, Brookfield is not going bankrupt. So this is where, when you see these kind of market dislocations in March and April, if you have the capital available at that point in time, and if you are not affected in your remaining portfolio, and you have your lines available, this is when you can really clean it up. This is when you can make a 40, 50 at a point in time. It was even an 80% IRR. And 80% IRR is also relevant because it's a 20% absolute return in 3 to 4 months, which is as attractive as it can get as such for a risk-free trade. So this is a very powerful example. Similarly, when you get towards the end, when you come towards, once approvals have come in, RBI, it's not about the market stabilizing, it's just the fact that the event has gone through the process. So you've got your RBI approvals, you've got your SEBI approvals, and then, in the last 1 or 2 months, this is where, the time frame is well defined. There is no market risk. And this is where, if you have the lines available, you can take a 200, 300 crore trade as well. So this is a good example of how financing can really work in a special situation strategy.